Any questions? Okay. Those are assets, liabilities, owner's equity. We know, though, that we have some other accounts. We have expenses. We have revenue accounts. And then we have that other thing called a withdrawal that we learned about in Chapter 1. So withdrawal is an owner taking out assets for his or her personal use. And that's allowed. That's allowed. That's not one of those, ooh, wait, that's personal, so we don't record it. No. If he's taking it from the business, we record it. Okay? So, expenses, revenue, and withdrawal accounts. These are all within owner's equity, but now we're kind of breaking them out. Because I don't want to dump everything in owner's equity. As an owner of a business, that doesn't help me make any decisions. And remember, one of the parts about being an accountant is helping to analyze and interpret accounting information. If I dump all of my expenses and my revenue in this capital account, I don't really know or have a good idea of how to say, gosh, I think we're over in advertising expenses. I think we need to cut down on advertising, because I wouldn't have a clue if I dumped everything in there. So we're going to have other accounts. We're going to have expense accounts. We're going to have revenue accounts. That's an E. And we're going to have what's called a drawing account. However, drawing is kind of a subset of capital because we don't do it that often. We're going to make its own account, however. All right? Now, on the handout I gave you yesterday, or I'm sorry, on Friday, we kind of talked briefly about these three because Chapter 1 groups them with revenue, and now they're sort of coming out of there. So expenses, debit, left, credit, right, gosh, that doesn't change. They increase, expense accounts increase on the debit side, and that's its normal balance side. Whoops, what is that? Let's think about this for a minute. Definition of expense is a decrease in owner's equity resulting from the operation of a business. I decrease owner's equity by debiting it. That's why in this category of accounts then, as I increase my expenses, I'm decreasing owner's equity. Okay? So I'm going to debit expenses always. Okay? Right now in your world, you will never credit an expense. It doesn't make sense. Think about it. If I debit an expense, it's getting bigger, bigger, bigger. So rent, I pay rent every month. What I've paid on rent over the years is just getting bigger, bigger, bigger. Okay? The opposite is true with revenue. Revenue increases on the credit side and decreases on the debit side. Definition of revenue, increase in owner's equity resulting from the operation of a business. As I'm earning money for the company by mowing lawn, cutting hair, whatever it is that I do in my service business, increase in owner's equity, credit side. So revenue is just going to keep growing, growing, growing as well. So I go mow the lawn, $50, dump it in revenue. I go mow another lawn, $50. Now revenue's up to $100. Okay? Revenue won't decrease. Doesn't make sense. Okay? So I'm going to come what and make your lawn grow? Doesn't make any sense. So revenue is always credited, always for you right now. You'll never debit revenue. Doesn't make sense. Drawing, we said is a contra account. What does contra mean? Opposite of. Okay? So drawing sort of acts a little bit like an expense because it's decreasing owner's equity. Okay? Because if I'm withdrawing something, withdrawing an asset out of my business, my owner's equity is going down. However, what the owner has withdrawn is getting bigger. It's going to be on the debit side. Again, this crap you might need to memorize right now. Okay? These three types of accounts you might need to memorize right now, but as we go, again, it makes sense. All right? So, all that being said, let's take a look at some transactions using these types of accounts then, please. Join me on 44 if you will. Book 44. Next page in your workbook. We're doing the same thing. We are analyzing transactions. We love analyzing transactions with T accounts. So T accounts are given in your working papers. We're continuing with that same chart of accounts from Bergam Supply. Okay, so that was back on the last section that we did. So we're continuing. On April 10th, received cash. Woohoo! Love received cash. Because I know what to do when I receive cash. From sales, $600. Received cash from sales. Well, what the heck is sales? Sales is my revenue account. In other words, the way I get money. Flip back to 37, if you will. Let's take a look what the heck kind of account I'm supposed to use for sales. I'm looking at page 37 at the chart of accounts there for Bergam Supply Services. Oh, there is a sales account. Okay? So the two accounts affected. Received cash for sales or from sales on April 10th. Those are my two accounts affected. Sales is a revenue account. Sales is a revenue account. Okay? Received cash from sales, $600. Still a little foggy on the whole revenue business, but I know what I do with cash when I receive cash. Cash is an asset. It is increasing. I increase an asset by debiting it. Sales is a revenue account. I increase a revenue account on the credit side. And gosh, when I receive cash for revenue or from sales, it's going up. I increase revenue with credit. Coincidence? I got a debit and a credit. I think not. It's the way it is. Again, if you know one, receive cash is always this. If you know one, assume the other if you have to right now. I'd love it if you understood it, but if you can't quite get there yet, I'm cool. If you know one. Ooh, on the 11th, sold services on account to Sam Erickson, $850. Sold services on account. What was services? I don't know what that is. Sold services on account to Sam Erickson, $850. Anybody know what services is? I look on 37. Is there some account there called services? Accounts receivable is going to be one, Sam Erickson. That's affected. You know it. AR, accounts receivable, Sam Erickson. So I went to Sam Erickson's house and I mowed his lawn. He wasn't there. I left a bill on the porch. It was $850. I did a really good job. Maybe I did some other stuff too, like planted some trees or something. I don't know. Ladies and gentlemen, services is our revenue account. It's sales. It's the only revenue account we have. Sales is always our revenue account. Okay? So I went to Sam's house. I mowed his lawn, sold services on account to Sam Erickson. Sales, revenue, going up. I know that revenue increases on the credit side. Sam Erickson, AR Sam Erickson, accounts receivable, is an asset. It's increasing because what Sam Erickson owes me has gone up. I didn't get any cash. He'll pay me later. But it's as good as cash. It's an asset. Sam Erickson owing me money is an asset, because a definition of an asset, anything of value that is owned. As much as I don't own Sam Erickson, I own that he owes me $850. When an asset increases, it's debited. When a revenue account increases, it's credited. That's what's happening when we sell services on account. Okay? On the 14th, paid cash for rent. Paid cash for rent. Look on page 37. Is there such an account called rent?
Yes.
Does it just say rent? Oh, okay. Another shortcut some of you will try. Please don't. There's no such account called rent. It is rent expense. Okay? If you must EXP, I get it as long as you get it. What other account is affected? Cash. Paid cash. My least favorite words, but at least I know what to do with it. Paid cash for rent. How much is our rent? $250. $250. Paid cash. Cash is an asset. It's going down. My cash account's getting smaller. I shall credit it. Rent expense is an expense account. It's getting bigger. What I am spending in rent is growing, growing, growing. I increase an expense on the debit side. And oh, by the way, Hopkins said I'll always debit an expense. So I shall listen. I have a debit and a credit. Received cash. Two favorite words together. Received cash on account from Sam Erickson, $425. Received cash on account from Sam Erickson, $425. Two accounts affected. Our cash and Sam Erickson. AR Sam Erickson. Received cash. Woohoo! Cash is an asset. It's going up. I increase an asset on the debit side. Accounts receivable Sam Erickson is an asset. It's decreasing. Because what I owe Sam, or what Sam now owes me, is going down. I decrease an asset on the credit side. I've got a debit and a credit. Lastly, on the 20th, paid cash to owner for personal use, $300. Paid cash to owner for personal use. Is this our friend Kathy? Kathy Burgum is our owner. Here's this new account called drawing. Kathy Burgum, comma, drawing. It is not Kathy Burgum, comma, capital. Because we have her own account that we keep track of all the drawing. So when she comes to us and says, hey, where is all of my money going? And you say, oh, well, Kathy, oh, by the way, you've withdrawn a lot of money. Oh, yeah, that's right. Okay? So the accountant, you kind of take some hits, but if she's taking money or other assets out of the company over and over and over again, her value is decreasing. Paid cash. How much does she want? $300. Paid cash. Cash is an asset that is going down. I will credit it. Kathy Burgum drawing is what's classified as a contra owner's equity. Contra owner's equity. It's not an expense. It's contra capital. Contra owner's equity. Okay? When it increases, because what she is taking out is growing, growing, growing. If we're keeping track, $300 here, $500 there, it's getting bigger, bigger, bigger. When I increase a drawing account, I debit it. I have a credit and a debit. It's not a coincidence, people. I must have a credit and a debit in every transaction. And they must equal. Always, always, always. Okay? They have all these dumb rules about stuff equaling and being in balance. Questions about any of those? And we are golden. We are golden for a long time. This is the toughest part. So those of you that are like, yeah, I got it, okay, I got it. This is the toughest part, I'm okay. If some of you are still kind of cloudy, it's okay. For tomorrow, if you will, on your own, holy Toledo, you've got 5, count them, 5 transactions. I think you can, I think you can.